Welcome back. Today I will talk about bond portfolio management. Now this is a topic which we will cover again in April once we include additional dimensions that need to be considered in terms of ethical considerations about sustainability and additional factors which are not yet captured in this particular setting. I will talk briefly about the investment management process. At this point, we don't yet focus on the aspects of ethical investment decisions, green investment decisions, and so on. Then I will talk about the tracking error. And in our live session, we go into active management because I have done some modeling for a client about, I think, 10 years ago. It's quite a complex model in Excel, and I will show you that, and I will show you how to build these models and how you can use them to assess investment strategies which are active. So in this particular case, I use strategies to exploit likely changes to the term structure of interest rates. Now let's get into this. Now the investment management process is all about setting the right goals to start with. Talking about risk appetite with clients, talking about also the investment horizon, which is quite important. In particular, when it comes to fixed income securities, timing does matter an awful lot. So if you have a longer time horizon, for instance, you might not be in any need to liquidate your position before maturity of an asset. You might be able to hold until maturity. Now this is quite important because most of the securities we are dealing with have very low levels of liquidity, which means it is quite expensive or very difficult to actually sell them if you need to get access to your investment very quickly. So these things need to be considered when selecting an optimal portfolio strategy. And once we meet in April, of course, we will add to this mix the issues around ethical investment strategies, and again also the issues around sustainability and a long-term focus in terms of your investment strategy. Now, from the main understanding of your goals, you also have to then make the most fundamental decision whether you are following an active investment strategy or a passive one. Now, there is a good amount of literature now that demonstrates that a passive strategy might actually outperform an active strategy. Now, passive strategies are focused on replicating an existing benchmark, like a bond market index in a certain field. Yeah? So, for instance, you try to mimic an index for high quality corporate bonds in a certain rating category. So in this particular case, your risk is a risk of not being able to match perfectly the benchmark. Now, benchmarking in the case of fixed income securities is slightly more challenging compared to the stock market. So stock markets tend to be usually more liquid. So sometimes it might be not as straightforward to exactly replicate a benchmark with a passive investment strategy. So there is some more work that needs to be done, and some additional risk factors that have to be considered. In particular, liquidity could be a major obstacle. If you want to go into this, also for your group presentation, I think again this is quite an interesting area to discuss active and passive strategies and to look at performance differences. There's a good amount of literature on that. Now, when it comes to green investment, we will also look into this more carefully. But of course, you don't have as many benchmarks yet, and the benchmarks you have, they tend to be not very established because you don't have a long history of their performance. But initial empirical work suggests that the performance of, for instance, green bonds is actually quite good, and in many ways they tend to outperform alternative investments. Now, in terms of what we do in portfolio management, we of course have to have a clear goal setting process done. We have to understand our risk appetite. We have to think, do we follow an active or passive strategy? If it's passive anyway, the decision is more or less made, because then my aim is to replicate a benchmark. So that of course limits my degrees of freedom to a large extent. In active strategies, there are then of course many potential things you could try to attempt. And these will be discussed in our live session. I will show you an example of an active portfolio strategy which uses also real data, and it's all built in Excel for a client of mine. Now, in terms of tracking error, that's now an important issue, in particular if you follow a passive strategy, because the main focus there is you want to hit your benchmark. Also for active portfolios, you tend to still have a benchmark. Of course, then the benchmarking is much more tricky, and of course many people use that in advertising. So when you go through adverts from various investment companies, they tend to argue, oh, we outperform the benchmark by X%. They don't necessarily always tell you that by doing so, which of course is quite possible, they might take much more significant risks. So there are different perspectives on risk-taking. One perspective, which in particular is a sensible perspective, is to look at the so-called tracking error. So here we actually focus on how close are you to the benchmark. And this is a very valid perspective in bond portfolio management. Now, the tracking error is derived from comparing for different time periods your bond portfolio return and the return you achieve on the benchmark. And you basically subtract the two, and you get a deviation from the benchmark. And you see this here on the right-hand side. And then, of course, looking at this deviation from the benchmark, you can calculate a standard deviation from that. And this standard deviation would be then a measure of risk, your tracking error. Now, you tend to perform this assessment usually with either weekly or monthly data. If you use weekly data, you then of course have to recalculate the annualized tracking error, because that tends to be the standard way of measurement. Now, what you see on the slide here is an example with monthly data where you take the square root of 12 and you multiply your monthly tracking error, which is your standard deviation of the deviation from the benchmark. Now, of course, you might ask yourself, why do I take the square root of 12? And that's actually interesting, because this stems from a few assumptions you make. The main assumption you have here is that these tracking errors and the standard deviation of them, they are basically what you call IID distributed. So that means they are identically independently distributed. So put differently, when you look at period 1 compared to period 2 or any subsequent periods, the deviation from the benchmark is not systematic. Yeah? It's a random deviation. So there is no correlation between these deviations. And if you make this assumption, you can then easily justify that if you look at the standard deviation over longer periods, you can actually start adding up these individual errors. In fact, you would start with a variance first. So the variance of two random variables is simply the sum of their variance, plus you have to then consider the covariance. But if they are independent, the covariance is equal to 0. So put differently, if I look at the sum of maybe two random variables, say A and B, and I want to assess the variance, it's simply adding up the two variances of A and the variance of B, because I don't have a covariance to consider if I assume they're independent. Now with the standard deviation, the only thing you do is you take the square root, hence you see here the square root of t, and t is the number of periods. So if you have, in this case, monthly data, you would have square root of 12. If it's weekly, you have square root of 52, and so on. So that's a standard way of measuring and assessing tracking error in an annualized fashion. Then there is a discussion between the backward and forward looking tracking error. Now backward is just what we have seen before. You do this based on historical data. So there is not much more you can discuss. You can easily implement that. Now the forward-looking tracking error is conceptually very different. Here again you make quite a few strong assumptions. So what you do is you assume that this deviation from the benchmark is indeed a random deviation, and you assume it's approximately normally distributed. Now these are quite significant assumptions, and we have to, of course, discuss that in maybe more detail. And then you can simply calculate from there the standard deviation. Yeah, in this example it's 1.5, and you have an expected value for the benchmark which is 8%, so you can easily derive the range of your tracking error with certain probabilities, and this simply comes from the assumption of a normal distribution, obviously. But of course the key question is it really normally distributed? And the answer is most likely not. Most likely you will have, also in this particular case, fat tails. That's quite a probability, in particular if you have significant liquidity risk, which again in the case of fixed income securities is quite likely. So one has to take these models always with a pinch of salt, because they do make rather strong assumptions, and I think that's important to have in mind. Now, in theory, of course, if you have a passive strategy, you should not have any forward-looking tracking error, because you would assume you would be able to replicate the benchmark. In practice, this is not necessarily the case. You always have some deviations for various reasons. Yeah? And as I mentioned before, one big factor could be liquidity. If you simply cannot always replicate perfectly a benchmark. And I think that is important to assess in this factor. Then, of course, there are various risk factors that you need to consider. And, of course, if you follow an active strategy, we will play around in the live session with these factors. Yeah? In particular, we look very carefully at term structure changes, shifts in the term structure, and how you could optimize your portfolio to benefit from certain changes. The good thing about term structure changes is that they are not completely unpredictable. So there's a certain pattern how the term structures tend to change, in particular whether the term structure becomes steeper or flatter, whether you have an inversion, which is quite unlikely. It's usually a signal for upcoming recessions. So there is a good degree of predictability, so you can position your portfolio to benefit from such systematic factors. And of course, when you have these unsystematic factors, actually these are idiosyncratic factors from a portfolio perspective, which are then linked to issuer-specific risks. So this goes back to our discussion of credit risk and so on. in a portfolio, you would hope you can diversify that away. And again, of course, you make certain assumptions that these issue-specific risks are not really correlated, which again is something you can question, and we discussed this also before when we went into the credit risk, that there are, of course, a ton of assumptions you make, and we know from empirical evidence that if there is a certain macroeconomic event, so these are actually factors that would level here on the systemic factors, you might see on a sudden correlations emerging between idiosyncratic risks, and then they are no longer really idiosyncratic because you can't easily diversify. So I think that's an important point to take. Good, so in the live session, as I said, I will go into the active management. I will show you a real example of a model which I constructed to follow active management strategies in the context of fixed income securities. Good, I look forward to seeing you in the live session.